Markets have obviously rebounded quite a bit since the last time we touched base, and I think there's a lot of things that are very important about this rally that are happening that we need to take a look at a little bit on a deeper level here. We're looking at right now a chart of the BTIC adjusted interest rate. For those of you that are new, this basically is a measure of the cost of equity, the cost of leverage. And essentially when it's rising, it's becoming more expensive to get leverage. And when it's falling, leverage is getting cheaper. This is measured in basis points versus the effective funds rate. Think about it as a spread. So when that spread is narrowing, it means that the cost of leverage is getting cheaper. And this is a very good gauge because it's worked really well for us in the past in terms of identifying that something was happening towards the end of 2024. Cost of leverage was exploding higher. We saw it then come down sharply into the beginning of the year. And I wanted to focus on this period of time specifically because if you notice during this period of time, the S&P 500 came down, the cost of leverage came down. Notice that the cost of leverage continued to decline even when the S&P 500 rallied. And then, of course, the S&P 500 fell sharply. Cost of leverage continued to decline and has continued to decline throughout all of these rally attempts. And this is an important distinction, I think, because when we go back and we look at this chart a little bit more closely, what makes it more interesting is when you look at other examples where we've seen very sharp pullbacks in the S&P. One such example was the peak in July, and then, of course, the Japanese yen blow-up trade. You can clearly see that during that period of time, cost of leverage was coming down, kind of signaling to us that maybe something was going on in the market. Cost of leverage began to rise on this as we were coming down. At this point, eventually we staged a little bit of a rebound, but then we saw the S&P plunge and the cost of leverage come down as well. Now notice that as we were rising during this entire period of time, cost of leverage was steadily increasing. Notice during this period of time, S&P 500 falls, cost of leverage comes down, cost of leverage is increasing along with the S&P 500. Notice this period of time, cost of leverage is increasing, S&P 500 is rallying, cost of leverage comes down, S&P 500 comes down. Cost of leverage continued to rise just about throughout that rally. Now notice in 2022, there's a big divergence here. You can see that again, cost of equity peaks sometime in November. Cost of equity really begins to plunge. Notice we get a very sharp rally in March of 22. Cost of leverage never rebounds, continues to decline. Cost of leverage tries to rebound with this S&P rebound in June. That obviously failed. We saw lower prices. Notice in the month of July and August, we saw that monster S&P 500 rally. Cost of leverage never confirmed it. It wasn't really until October of 22 that the cost of leverage began to verify the move we're seeing higher in the S&P. Why is this important? Because notice that since this rally began here, cost of leverage has actually continued to decline. It has not confirmed the move we are seeing higher in the S&P, and that looks very similar to what we were seeing happening in this period of time, where in this period of time, the cost of leverage was continually rising throughout the S&P 500 index. It's a very easy index to find. It's on TradingView. AST2 exclamation point is the one that I use. You can also then, of course, use individual months. This is the December contract. You can see that actually continued to move lower as well, even on Friday. So what this is telling us is that at least at this point, the cost of leverage is not increasing. You're not seeing it confirm this rally. And so then you'll say, well, why is the equity market rallying? And I think a lot of it is largely to do to the implied volatility declines we've seen. Now, I thought last week we were going to see implied volatility stabilize and actually begin to go higher. One reason why I thought that was likely to happen was because 10-day realized volatility was really stabilizing around this 20 area. And so I expected realized volatility to be below implied volatility. And I thought with all the events going on this week, you would see implied volatility rise. That obviously didn't happen. We saw implied volatility on the S&P 500 come down. And now you can essentially see that 10-day realized vol is trading in line with 1 month implied vol. And we have started to see 20-day realized vol coming down. Now, 20-day realized vol will continue to come down. And the reason why I'm using 10-day realized vol is because 20-day realized vol will eventually come down to where 10-day realized vol is at this point. And so when we just take a look at this, what this is telling me right now is that realized volatility has really continued to come down all this week. And that's also been partially to blame for why the equity market has been rising. And so why is that to blame, or why is that something to be aware of? Because what's basically happening is that when we look at the S&P 500 right now and look at where it is at this point in terms of delta exposure, you can see that right now the delta exposure is become very green again, meaning that there's positive delta exposure in the market. And why is this important? Because if you had looked at this chart 2 weeks ago or 3 weeks ago, you would have seen a lot more red, and you would have seen red going down to much lower levels because there would have been a lot of puts that were in the money. And obviously since that time, implied volatility has come down. As implied volatility falls, it decreases the value of put. That means that the premium values on the puts come down. As the S&P 500 rises, as implied volatility is falling, puts lose value, puts get sold. That pushes implied volatility down further, and it creates sort of this period we're in right now where you're seeing basically puts getting closed out, puts basically burning, pushing implied volatility lower and the S&P 500 higher. And what really makes the dynamic all that more powerful is that you're in a period of time where liquidity in the market is very thin and the cost to trade is very high. So what this is basically telling us is that the top of book, which is a measure of the number of shares on and off on the bid and on the offer, has declined to very low levels relative to where they've been over the last 2 years. You can see that we're at the margin, the top of book levels are very tiny compared to where they had been during more ample periods. Also notice the trend line as the top of book has thinned, the cost to trade has actually increased. If we look at this on a weekly chart, it becomes a little bit more visible and easier to see. It's just costing a lot more to trade today because the top of book is much thinner. And that's because really, when you look at it, the bid-ask spread has also widened to some degree. You can see it's not clearly as wide as it was, let's say, towards the middle of April when we were seeing very big moves. But more importantly is what you can see is that it is higher than where it is. And so when the bid-ask spread widens out, the cost of trade widens out. And that's simply because if there used to be 10,000 shares bid and offer and there was a penny spread in the futures or whatever it may be, it may only take you could maybe have 5,000 contracts to buy and you could get filled right on the offer. And in a market environment like this, you may have 10,000 contracts to buy, but the offer is only at 2,000 contracts. The spread is, let's say, 2 or 3 cents. So you buy your first lot at 2,000. Now you have to take it higher again, until you get filled. And that moves the market a lot more. And so you get these crazy moves in the market, like what we've been seeing, where you'll get these sudden spikes in the S&P 500 futures like we did on Thursday night at 8 o'clock p.m., you had a sudden rise of about 83 basis points in the S&P 500 futures on just 23,000 contracts. Now compare that to 8:30 in the morning. After the job report, we went up also 84 basis points, but it took 63,000 contracts to move the market. And so this really kind of gives us a sense of the changing dynamics in the market. This was also, here was that crazy end of day that we saw on Wednesday afternoon when we saw the market rally out of thin air. You can see again, very thin markets. It doesn't take a lot to move it, and you can see we also had a very big 85 basis point rally. Just likewise as well, you saw the S&P 500 drop by 95 basis points at 8 o'clock in the morning following that GDP print. It also came on very light volume, just 70,000 shares. It fell another 95 basis points on 240,000 contracts. So what this is telling us is that you can move the market a lot, and sometimes especially when it's early in the morning or late at night, and it doesn't really take a lot to move it because there's just not a lot of liquidity in the market. The other thing that I wanted to note here when we look at what's happening, at least across other parts of the market as well, right now you're looking at a British pound cross-currency basis swap, the 5-year type. And what this is basically showing you right now is that the British pound, the cost to hedge the British pound right now was getting a little bit more expensive in pound terms on Friday. And this is an important thing to keep note of because you're seeing this across all the cross-currency basis swap spreads. And these really give us a good sense of, the hedging costs and the liquidity factor that may be coming in from overseas. This is the Japanese yen version. And the Japanese yen kind actually started to tighten up on April 25th, and it continues to tighten on Friday as well. And so this is also an important factor and thing that you can keep track of as well. Because again, a lot of these dynamics are in play. And so what this is kind of all implying to me is that at least to this point in the marketplace, you're not getting the typical confirmation signals that you would normally see. And that doesn't mean the market can't go higher. I'm not saying that. What I'm saying is that you're not seeing the confirmation signals that you would want to see to tell you that this is probably the start of that we've seen the worst in the market and that things are only going to be better from here. What the non-confirmation signals are telling us to still be very careful that the rally may not really be real. And if it's been mostly mechanical in the form of an option market implied volatility reset, it's likely not to persist as well over the longer term. And so I think these are very important details that really can give us a sense that maybe the market isn't quite as strong as it seems. And a lot of it has to do with hedging flows and unwinding of flows because we're not seeing those confirmations, that you would want to see to tell you that maybe the worst is behind us. Anyway, I hope you have a great weekend. I hope you remember to subscribe to this channel, like this video, share with your friends, and please help me to continue to grow the channel out in 2025. Have a good one. Bye.